Well, as consumers head to the grocery store every week or fill up at the pump, they be making decisions based on how they see prices going up. But do they understand the global picture on the economy? How a stable labor market just put inflation back into the driver's seat? Welcome back to the States. I'm Greg Bishop. For Everyday Economics this week, I talked with Ph.D. economist Orphe Divounguy about how the labor market stopped being the Fed's biggest worry. The labor market stopped being the Fed's biggest worry. Unemployment is steady at about 4.2%. It's very low layoffs. Got that and the June jobs numbers not tipping into broader weakness. That dual mandate of maximum employment and stable prices seemingly flipped. Now, inflation risks are the dominant concern heading into this week's FOMC meeting. Walk us through the latest labor market data and what exactly this is doing to the Feds and the risks that there are about being broadly balanced.
Yeah, no, all of 2025, we basically had almost no jobs created, right? The labor market looked softer and looked like it was deteriorating. And so we began 2026 asking when the Fed would cut. Now markets are debating whether or not it might hike. You've mentioned the mandate, right? It's maximum employment, stable prices. And ultimately, if the labor market is not collapsing or even deteriorating anymore, and the unemployment rate remains pretty low, then the concern has to shift to the other side of the mandate, which is inflation. We got war, we got tariffs, we got federal deficits that are pushing inflation higher. We got that big AI investment boom. All of them push inflation up, not down, and so the Fed has to react appropriately.
So, what does that reaction look like? Is the reaction making things tighter, or are they able to ease things and possibly lower interest rates or increase interest rates?
Yeah, I mean, inflation's moving up, and so when inflation moves up, the reaction is to raise interest rates, right? And so that's what it looks like right now. Of course, I've been making the argument for a while now that potentially the supply shocks that we got, right, the big increase in oil prices could be disinflationary. What do I mean by that? It's a tax on households, right? So I have to pay more to for the food, the transportation, the food, the deliveries, everything that shows up at my front door, is facing a price increase, and that price increase in an environment where people are not able to get a raise is ultimately going to squeeze the household and cause them to spend less. You add the fact that credit card rates remain elevated, that mortgage rates remain elevated, that you're seeing the shift in interest rates. That's also a squeeze on households, right? So that's one side, one way of thinking about it. That's one argument that some are making, and I've been making that argument. The other side of the picture is to consider that, well, if prices remain elevated and continue to rise, well, maybe inflation expectations will not remain anchored. People, what do I mean by that? I mean, basically, people are going to start to think, well, you know what? If inflation is going to continue to keep rising, maybe I need to go out and spend now and not face higher prices tomorrow or in the future. And so what happens when people start to think like that is, well, they go out spending, and that spending causes inflation to increase even more, right? And so there are these two competing theories right now to consider. And I think more and more people at the Fed are leaning towards, well, household inflation expectations seem to be moving higher. And so we need to be worried about that, because again, if inflation expectations start to move higher, people will go out and spend more now, expecting prices to be higher in the future. And so that's the challenge for policymakers right now. And I think more and more policymakers are really thinking through that second point I'm making, right? That if inflation expectations move higher, they will have to act. For now, they've moved up slightly. I expect the July meeting this week to keep rates on hold. But if inflation continues to move higher and that war in the Middle East continues to intensify and oil prices continue to increase, I expect them to start considering a rate hike before the end of the year.
Yeah, and you're looking at CPI somewhat soft in June, but it sounds like you're saying that's not really, the consensus that that's going to stick around. That it's just temporary. That it's soft.
It was temporary. Why was it temporary? Because look, we have that oil prices started rising again. Things were moving in the right direction in the Middle East. They're not anymore, right? I heard over the weekend there might have been a little bit of a pause in the fighting, but that's not enough to bring oil prices back down. So that's the first thing. The second thing is the Treasury plans to borrow $671 billion this quarter. If we continue to push fiscal deficits ever higher, it's going to show up. It's basically added demand, right, in the economy, is government spending. And that demand is going to put upward pressure on prices. And I'm not done yet. I mentioned the AI investment boom, right? And that's another demand story. So you got the supply story, right? Supply shocks that are pushing prices higher. You got the demand side of the economy that's pushing prices higher. And that's worrying because it means even if you get rid of the oil shock, inflation may not be returning to 2%, right? To the Fed's target as soon as we thought, as fast as we thought it would.
It's interesting how, we seem to hear about these prices being delayed from when they actually happen. Like, how quick actually does the price of oil feed into that inflationary number? But also something interesting, Orphe, that you've pointed out in recent columns is the shipping methods. And if they have to, move routes around, people are looking at how that adds to the overall cost of energy. What does that do when somebody says, "Hey, we have to add 9 days"?
That's right.
To get around a major strait.
That's right. It's not just the cost of energy, right? It's also the different transportation costs in general. Now you're looking for different ways to get things to you when you have the strait blocked, and so it's also other companies, right? Trucking routes, that are now going to say, well, we have all this demand for stuff to get around, by truck now instead of by ship. And so all of a sudden, it's all of this infrastructure and all of these prices that have to go up. And so that's going to affect the price of everything that shows up at your front door, including the food at the grocery store, right? Then there's maybe one more point that I forgot to mention is the fact that there's a recent New York Fed survey that came out and said that roughly half of companies that paid a tariff plan to raise prices, right? Pass on those costs to consumers. They haven't done that yet. And so you have all of these forces that are kind of pushing in the wrong direction. And so unfortunately, that tells me that even if just one of them gets resolved, let's say we get the oil shock, the oil prices coming down, that doesn't get rid of all the other forces at play right now that are keeping inflation elevated.
Orphe, obviously there's going to be much more to come on this issue of the economic impacts of the various pressure points you outlined here, and that's why we bring you Everyday Economics here with the Center Square.